Okay, guys, we're going to talk a little bit about a scenario where I'm going to decide, do I want to do I want to own shares, or do I want to play this using an option? Now, this is only one scenario, just to give you an idea on how it can be used. There's many other ways that options uh, can be used to enhance or protect the portfolio, and we'll get into those examples after we come back from spring break. But here we're just talking about a situation with a stock that we've been following. We'll call it XYZ Corp. XYZ Corp currently is trading at $30 per share. We've been watching it for a while. It goes to 40, it dips back to 30, it comes back up to 40, dips back to 30. So the whole market's been down. We notice it at 30, and we can say if we buy 100 shares at 30, it's going to cost us $3,000. Okay, that's a good amount of capital right now. Okay, now I've been eyeing that move back to 40. This is what we're hoping to get to. If we're buying it at 3,000, hoping that one day it gets to 40, we can sell it and make 4,000. We'll pocket $1,000 of profit off of a $3,000 investment. So the return, the ROI on that would be 1,000 divided by 3,000, or 0.33, so a 33% return on investment. So I'll put that out here as well. So a $1,000 gain is nice. The return on investment is pretty good, but this is a lot of capital that I have to outlay in order to get exposure to this move. Now, when I put $3,000 in that investment, I have $3,000 worth of risk. If XYZ Corp goes out of business, okay, or maybe it was misstating earnings or something like that, or something was happening inside the company that we weren't privy to, okay, this could go to zero and we could lose all $30,000. That's a risk that we have to take on. We have to understand anytime we purchase anything. If you don't take my word for it, take, I think, Luckin Brands coffee, take a look at that stock, LK, today. Now, I want to capture value in that move back to 40, and I don't have a lot of cash in my account. So a cheap way to do it is through the options market. I can buy one contract, which represents exposure to 100 shares. And currently that one contract is trading for a premium of $2, okay? The premium is $2, so I can buy an option for $2, but 2 times 100 really means a cash outlay of $200. It's going to cost me $200 to buy that one option contract, which has the right to purchase 100 shares at $34 anywhere from now till September. Okay, I have the right to buy at $34 anywhere, anytime from now until September. Okay, the premium I pay is $2. Since there is no intrinsic value in this option right now because it is much cheaper in the open market to purchase this. So no one would want to purchase at 34 when the stock is trading at 30. So right now this has no intrinsic value. The premium that we're paying for is all extrinsic value, which means it's capturing volatility in the market and how much time we have from now until the option expires. So this is all an extrinsic value, okay? Now, when I take a look at this, since I paid $2 to buy at 34, my break even is $36, okay? So if it goes to 40, which is what I was planning, like it's the reason why I bought it at 30 here, I was hoping it goes to 40. If it goes to 40, I'm gonna make $4 on my option contract times 100, so I'm gonna make $400. But I'm making $400 off of a $200 cash outlay, okay? So if I get the move that we're anticipating, I can put a fraction of the money in and I can make $400, which of course is a lot less than this, but I'm risking a lot less capital to do it. Now my return on investment is going to be, it's going to be 200% here, okay? So now a 200% ROI compared to a 33% ROI, that's one of the reasons why people enjoy the option market, because when you get the move that you're looking for, you get a nice percentage win. Okay, realizing though, just like in this case, this could go to 0 and I lose all 3,000. This might not make it to 34 and I lose all my 200. Okay, so this is a risk that you have to understand when you dabble in the options market. Okay, let's say we get the move that we want. So later in the year, let's say this happens, we get the move, now it's trading at $40 per share. Okay, we just, our shares are now valued at $4,000. We have a profit of 1,000. Okay, again, off of an initial investment of $3,000, which means our ROI is 33%. Okay, we made $1,000, but we had to risk 3,000 in order to do that. Over here, we get our move. Okay, now we can purchase shares for if we exercise the option, we can purchase shares for $34. Okay, we can sell them. Excuse me, let me do this the other way around. We're going to purchase shares, so it's a cash outlay for $3,400. We're going to turn around and sell in the open market at $40 a share. We're going to make a profit of $600 off of the share transaction. But we did have the cost. We paid $200 to do that. So we made $400. $400 when compared to our cash outlay was 200%. Okay, so now I'm gonna say that this happened. This price move happened right before the option was going to expire. Okay, so this situation was ideal, what we were looking for. But in this case, $200 cash outlay. We made $400 on the transaction. Okay, here $3,000 cash outlay. We made $1,000 in the transaction, but you can see percentage terms, it's a lot different. Now, options actually trade very similarly, although in a much less liquid market, to stocks. So in a situation like this, let's pretend one of the reasons we were playing the options market is because we didn't have $3,000 in order to make the purchase. Okay, so we were just playing this or buying this in order to sell this. Now, there was extrinsic value in this, okay? Meaning there was volatility in the market and there was time before the option expired, and that's priced into the option premium that you're paying. Okay, so now but in this case, there was 0 intrinsic and $2 extrinsic. Now, if the price move happened really quick, and let's say it's March, there's still a lot of time until September. Okay, we moved to $40 a share. The option premium is not going to be at $6. It's going to be at more than that. There's going to be some intrinsic value. For one, there's volatility because the stock is moving in value. Okay, so there's volatility that gets priced in, and there's time to expiration, and there's an intrinsic value here. When we move into, I'm sorry, let me just make up a price. Let's pretend that the option premium went from $2 per contract to, let's call it $7 per contract, okay? At $40 per share, this call is $6 in the money. It's $6 in the money. It is much better to buy at 34 than in the open market at 40, so this call has a lot of value in it. That option contract is trading for $7, so that means since $6 are in the money, there's $6 of intrinsic value. Of the $7 option premium, $1 in this case is extrinsic. Okay? Because some time passed from when it was at 30 to when it was at 40, so there was the time decay or erosion of the value of the option as we got closer to that expiration date. Now, not all of the extrinsic value decayed. There's still some left, and that's whatever's in excess of how much you're in the money. So intrinsic is in the money, extrinsic is anything over that value. Okay, so in this case, if I didn't have a lot of cash and I didn't have the dollars to buy the 100 shares, I would play the option market, but trade the option and not actually exercise it.